Okay, let's go ahead and go through the solution to example 5.1. This is a partially owned subsidiary acquired at other than book value, and we're going to go ahead and do the equity method entries and the elimination entries in the worksheet for the first year of ownership. So we have that on January 1st, 2020, Big bought 80% of Little's common stock for $320,000. The fair value of the non-controlling interest at that date was $80,000. The book value of Little was $300,000. They had the following misvalued assets. Inventory was undervalued by $20,000. Property, plant, equipment was undervalued by $70,000. First we have to do is go ahead and go through and do our differential analysis. Again, so we're going to compare the cost or fair value of the business unit to its book value and determine why that discrepancy exists. So again, we're going to need a column for our 80%. As well as a column for the 100%. The value, the cost or the fair value, our share was $320,000. The total was $400,000. The book value looking at, well, it says here book value is $300,000. That's the total. Our share would be 80% of that, or $240,000. For a differential equal to the fair value of our share minus the book value of our share, $80,000 for our share, total $100,000. Again, why does that exist? Well, we have some undervalued inventory, so we'll go ahead and subtract out the undervalued inventory. Again, I gotta make this bigger and bigger. Total undervaluation was $20,000. Our share, 80% of that. We've also got some undervalued property, plant, and equipment. Total undervaluation, $70,000. Our share, 80% of that. And then lastly, it wasn't mentioned explicitly up here, but note that down in the trial balance, Little has goodwill of $10,000. And as was mentioned previously, way back in an earlier lesson, the subsidiary's goodwill does not survive the consolidation process. Again, intangible assets that we record are those which are either separable or arise from a legal or contractual right. Goodwill is neither of those, and so it might seem sort of pointless, but we're going to go ahead and eliminate the subsidiary's goodwill. And the reason it seems pointless is because we're simply going to replace it, assuming there is goodwill, we're going to replace that with a new revised goodwill figure on the consolidated balance sheet. In any event, we view that goodwill as being overvalued, so we're going to go ahead and add the overvalued goodwill. Again, the total was $10,000. Our share, 80% of that. Okay, so the remainder is going to be goodwill. And you need to be a little bit careful here because we have, two subtractions plus one addition. So basically for the total, it's going to be the differential minus the portion that was explained by the inventory, minus the portion that was explained by the property, plant, equipment, plus the overvalued goodwill. And our share of that would be 80%, or $16,000. Okay, let's go ahead and do our equity method entries. Equity method entries, we're going to acquire our investment for $320,000. And now we're going to have income, dividends, amortization. Investment income. Okay, we look at this worksheet, and let's go ahead and go through this real fast before we do anything else. Let's go ahead and work our way down each of these columns. So for big company, their income is going to be the revenues minus cost of goods sold minus depreciation minus other expenses plus their investment income. That gets transferred down to the statement of retained earnings. And now we can do the statement of retained earnings. Ending retained earnings is equal to beginning retained earnings plus income minus dividends. And then we take that ending retained earnings and transfer that down to the balance sheet as ending retained earnings. And I can just simply copy those across because it's the same formula. And as you're doing these, it's always nice just to confirm that your ending balance sheet balances. So I'm going to go ahead and do assets, added up all my assets, and now I'm going to subtract my liabilities. I found a typo. Okay, so that equals 0. And again, copy that across. That equals 0 also. Excuse me. So my balance sheet balances. That makes me kind of happy. Okay, in any event, investment income. A common mistake that people make, which I want to be sure you don't make, is they say, well, I'm simply going to look at this and say, hey, my investment income is $50,400. This $50,400 is the result of numerous entries which might affect investment income. And again, in this example, we're going to have our share of the reported earnings plus or minus our share of the various amortization entries. Similarly, as we move further into the course, we're going to have other things that affect investment income as well. So again, it's nice to do this in a slow, systematic fashion. So first, our investment income is a credit, obviously. We debit our investment in little, and again, it's going to be our share, 80% of little's reported earnings, $72,000. I just copy that. Dividends. We receive 80% of the dividends that little declared. And again, looking at the worksheet, right dead center in the little column, you see dividends they declared in paid 20,000. We would have received 16,000. That reduces our investment in little. And now we have our two amortization charges. Basically, we've got this inventory, which is undervalued by $20,000. Our share of that was $16,000. That is going to need to be written off because the inventory has been sold. So again, whether you want to think of this from the balance sheet perspective, saying that part of that investment in little account that we acquired for $320,000, $16,000 of that was attributable to this additional inventory value. That additional inventory no longer exists. If you want to think of it from the income statement perspective, you'd say, look, little company reported earnings of $90,000, but that was based on a flawed cost of goods sold number. They had understated their inventory at acquisition, which means that when it was sold, they understated their cost of goods sold, which means they were overstating their income, which means we overstated our investment income. So we need to go ahead and adjust our investment income downwards by our share of that cost of goods sold adjustment. Same thing for the undervalued property, plant, and equipment. Our share was $56,000. That's being written off over 10 years. So $56,000 divided by 10, $5,600. And again, that's going to be a reduction in our investment income. And it reduces our investment in little. Okay. Now, just to confirm this investment income number of $50,400 in our worksheet, let's go ahead and add up our investment income as we've recorded it here. So basically what we had was our share of the reported earnings, credit to the investment income, that's positive, minus that debit to investment income, minus that next debit to investment income. $50,400, which matches this, which is, again, it's a sign that we're doing this properly. Let's go ahead now and do our elimination entries. And before I do that, I want to stress again, as I've noted in a couple other places, when you do work like this, either in your actual job or more immediately for class, I need to know that you know the difference between equity method entries and elimination entries. And so please put in big, bold font that these are our equity method entries. Over here, we'll do our elimination entries. Okay, and you're going to need some more space for my account titles. Okay, so again, first we have our S entry. We're going to eliminate the beginning of year common stock. We pull that right off the worksheet. We're going to eliminate our beginning of year retained earnings. Beginning of year retained earnings, up in the statement of retained earnings, was 250. Again, this number down here, this 320, down at the bottom, that is our ending retained earnings. We want to, in the S entry, we want to eliminate our beginning retained earnings. And now we need to record these various differential items. We're going to go ahead and their inventory was undervalued, so we're going to go ahead and increase their inventory by $20,000. Similarly, their property, plant, and equipment net, again, we're dispensing with the separate accumulated depreciation account for the moment. The property, plant, and equipment net was undervalued by $70,000, so we're going to go ahead and write that up. And we're also going to record, well, let's just go in order. We're also going to get rid of their $10,000 in goodwill. Again, we're getting rid of Little's date of acquisition goodwill to be replaced with what we just recorded of $20,000. Okay, now obviously, we could just as easily have simply debited goodwill net for $10,000. If we hadn't done this, then this would be $10,000, this would be $8,000. It's good. It's correct. It's proper to always do this and say, look, I need to eliminate. I need to treat the subsidiary's date of acquisition goodwill as being overvalued, as in fact being valueless, and I'll replace it, if appropriate, with a new goodwill figure of $20,000. In any event, we add all this good stuff up. That all adds up to $400,000. Our share through the investment in Little is going to be 80% of that. The non-controlling interest is the other 20% of that $400,000. So again, basically we take this total, whatever this nets out to, in this case $400,000 net debit, and we split that $400,000 net debit 80% to our, the parent's investment, 20% to the non-controlling interest. Now we do our A for amortization. Again, we have these two finite-lived differentials. That means they're going to be consumed or used up or whatever over some number of years. The inventory gets sold immediately. So basically we created $20,000 of inventory and now we're going to sell it. So we adjust cost of goods sold upwards by $20,000 and we take away that $20,000 of inventory that we created. So basically we add 20, we take away 20. Okay, next, the amortization of the property, plant, equipment differential. We had a $70,000 differential being written off over 10 years, or $7,000 per year. So we're going to go ahead and record $7,000 of depreciation expense. And rather than using a separate accumulated depreciation account, we're simply using property, plant, and equipment net, just to make life a little bit easier. I for investment income. This should be the easiest entry of them all. Basically, if you look at the income statement, Big has $50,400 of investment income. That has to be eliminated. It's not the $72,000 their share of the reported earnings. It's simply whatever's on the income statement as income from your subsidiary. It's got to go away. So investment income, if it's positive, is a credit balance. So to eliminate that, we're going to debit investment income. And that reduces our investment in Little. D for dividends. We need to eliminate Little's dividends declared. Looking at the worksheet, they got $20,000 in dividends declared. So we're going to go ahead and credit dividends declared. And again, that's going to be split 80-20 between the parent's investment in Little and the non-controlling interest. Okay, lastly, income to the non-controlling shareholders. Again, they're going to get their share of the adjusted earnings. So basically, they're going to get 20%. We start with reported earnings, and then we look at our elimination entries and say, how did these entries affect earnings from the subsidiary? Well, this A entry put a $20,000 debit on the income statement. Debits on the income statement make income go down. So we're going to go ahead and reduce earnings by $20,000. Similarly, this second A for amortization entry added $7,000 to depreciation expense. Another $7,000 debit on the income statement makes income go down by $7,000. So the non-controlling shareholders are going to get their share, 20% of the adjusted earnings. So the adjusted earnings, 90 minus 20 is 70, minus 7, $63,000. 20% of $63,000 is $12,600. So the income to the non-controlling interest, oops, and that adds to the non-controlling interest. Okay, this, I'm going to put that in big, bold font so everybody knows. Again, equity method entries versus elimination entries. To my way of thinking, this is the hard part. And again, it will get progressively harder as we add layers to these problems. Once you do this part, it's simply a matter of taking that data, those entries, and transcribing them to the appropriate place in the worksheet. Debits to the debit column, credits to the credit column. So let's go ahead and start doing that. And again, with Excel and the mouse, I can do this fairly easily. So one by one, common stock, 50,000. Beginning retained earnings, 250. Inventory, I'm going to add 20,000. Property, plant, equipment net, I'm going to add 70,000. And goodwill, I'm going to add 20,000. On the credit side, I've got a credit to goodwill of 10,000. I've got a credit to my investment in Little of 320. And I've got a credit to the non-controlling interest of 80. Okay, so just copying debits to the debit column, credits to the credit column. Only really tricky thing to keep in mind again is we always adjust beginning retained earnings, and you have to keep in mind the distinction between the investment and the investment income. Okay, next the A entry. I'm going to debit cost of goods sold up in the income statement, and I'm going to credit inventory down at the balance sheet. Next, I'm going to debit depreciation expense up in the income statement. I'm going to credit property, plant, equipment net down in the balance sheet. I'm going to debit investment income up in the income statement. I'm going to credit investment in Little down in the balance sheet. D for dividends. Debit to the investment in Little, debit to the non-controlling interest, credit to dividends declared. Then lastly, a debit to the income to the non-controlling interest up in the income statement, and a credit to the non-controlling interest down in the balance sheet. Okay, so again, just using my mouse and the plus key and the enter key, I'm transferring all that data. Now let's go ahead and fill this in. Okay, keeping in mind the debit and credit rules. Sales, there are no adjustments, so we simply add them together. Cost of goods sold, debit plus debit plus debit. Depreciation expense, debit plus debit plus debit. Other expenses, whoops. Other expenses, debit plus debit. Investment income, credit minus debit. For the net income, again, I don't add across this row. Instead, I work my way down this column. So my net income, revenues minus cost of goods sold minus depreciation minus other. Net income, I have my income to the non-controlling interest. And again, that is an allocation of part of that $153,000. So of the $153,000, $12,600 goes to the non-controlling interest. The controlling interest gets the other $140,400. Okay, statement of retained earnings. Credit plus credit minus debit. I transfer this down from the income statement. Dividends, debit plus debit minus credit. My ending retained earnings, again, I don't add across, I work my way down. So ending retained earnings, beginning retained earnings, plus income minus dividends, and I transfer that down to my balance sheet as ending retained earnings. And I like to do that right away because if you get on a roll filling these in, you might just not stop in time and add across this row. So by populating this cell in advance, I know that number's done. Okay, balance sheet. Assets, debit plus debit. Inventory, debit plus debit plus debit minus credit. Investment, debit plus debit minus credit. That's one of my check figures. It goes to 0. I'm happy that went to 0. If it didn't go to 0, I must have done something wrong. Property, plant, equipment, debit plus debit plus debit minus credit. Goodwill, debit plus debit plus debit minus credit. Other assets, debit plus debit. Jumping down to the credit side, credit plus credit with no adjustments. Bonds payable, just that one. Common stock, credit plus credit minus debit. Retained earnings is already filled in. And so finally, the non-controlling interest, credit minus debit. Okay, and again, just to wrap things up, let's confirm our balance sheet balances. Asset plus asset plus asset plus asset plus asset plus asset. So those are my total assets minus my liabilities. Okay, so my balance sheet balances, I'm content with this example. Holy moly, 25 minutes. Okay, thank you.